Hello, this is Christian DeHaemer. Welcome back to 5 in 5, where we attempt to answer 5 questions within 5 minutes. First question, what are emerging markets and how do you invest in them? Emerging markets are simply markets that aren't advanced markets. So you have, Japan, Europe, United States, Canada, Australia are, developed markets. And so emerging markets are more along the lines of India, Russia, Brazil, Argentina, things like that. Vietnam, Thailand, Indonesia. And how do you invest in them? Well, there's a number of ways to invest in them. One of the ways is through a ETF or mutual fund. You can get these country rated funds. On Mexico, you can buy the Mexico ETF. You can buy Saudi Arabia ETF. You can buy, all of them. Japan. You can buy any number of them. You can also buy what's called an American Depository Receipt. An American Depository Receipt is, I think it's JP Morgan, buys up a bunch of stocks. So they're always big name companies or blue chip stocks in, say, India, like Wipro or ICICI Bank. And they'll deposit these stocks in New York, and then you could just trade via, the New York Stock Exchange using these ADRs. What's the Big Mac Index? The Big Mac Index was developed by The Economist. It posited that there are McDonald's in every country on Earth, or almost every country on Earth, and they sell a Big Mac. And this Big Mac is comprised of meat, cheese, bread, produce, but also includes the price of wages, taxes, rent. Everything in a country is in a Big Mac, and each Big Mac is identical around the world. And so if you sell a Big Mac for $6.90 in Geneva and a Big Mac for, $1.29 in India, then by definition, Indian currency is undervalued compared to Switzerland currency. What this does is that it helps you see relative value of the currency. So if you cross-index it with, like GDP growth or some other fundamental values about a country, you can seek out what's a good country to buy. Or you can further, filter down into what you want to know. So if you start out, say that India has a cheap Big Mac, so its currency is undervalued. They're also growing 6.5%. And, they have 12 companies that are on ADRs that trade in New York. You can look at those 12 companies and see if you find something you want to buy. With the rise of AI, what impact do you foresee on emerging markets, and how can investors take advantage of this? Well, the thing about what's going on in emerging markets and with AI is we're having this period of global population decrease. So like China is losing, a large amount of its working population over the next 30, 40 years. And so is, Western Europe, Russia, all over the place. And so what you have is a reorientation of what gets manufactured and where it gets manufactured. And so part of that is new manufacturing will be artificial intelligence. And so so if you can make something in the US using AI cheaper than you can make it in China, you will. And that's happening. But it's also happening in places like, Taiwan and Vietnam and, Indonesia, India. What are the potential risks and rewards of investing in emerging markets compared to more established markets? Well, there are, the thing is that emerging markets tend to run on a 10 to 16-year secular cycle. And investing at the right time in emerging markets, when they're about to take off, when you're taking advantage of that value, it can be, 10 times more rewarding than investing in, the New York Stock Exchange or the Dow or the US indexes. But the variable, of course, is currency. So if the dollar's heading up, like it has been over the past 12 years, you want to be in the US market. If the dollar starts to head down against other currencies, you want to be in those markets, or at least have some of your money in those markets. Will AI stocks have a bigger run than tech stocks in the 90s? I assume here we're talking about the late 90s and internet stock, which, if memory serves, was the second. It was the number one biggest bull market of all time until we got to Bitcoin, which just blew it out of the water. Part of that has to do with liquidity. So the only way AI stocks will have a bigger run than tech stocks in the 90s is if we start cutting rates and we get a big liquidity surge that pushes another bubble higher. Longer term though, the tech stock in the 90s lasted about 5 years. And so I could see AI stocks lasting, 20 years. So, the cloud stocks lasted about 10 years now, 12 years. But then again, the internet stocks are still going. Amazon's returned a tremendous amount. So over the next 5 years, my answer will be no, but, with low conviction. That's all for me, Christian DeHaemer. See you next time on 5 for 5. Click, subscribe, link,